Hi guys, let me welcome you to another interesting discussion in your performance management syllabus. This will also help those who are writing advanced performance management or those who are writing the management accounting course of ACCA. Today's discussion on variance analysis will help all of those as well. Now, before we get into an understanding of what variance analysis is all about and what kind of calculations are going to be there. Do we need to learn any formulas? To understand that, we'll have to first of all get a proper understanding of why exactly is variance analysis done. Now, every organization creates a certain budget for the year. Now, talking about the budget is an indication of the plan for that particular period. How much sale do you intend to achieve? How much cost do you think you will end up incurring? You prepare a budget for that. Now, this budget is prepared using certain information about the past data that you have, looking at how trends have progressed. And along with that, you also get information about the current market conditions or how has the economy worked, and on the basis of that you create budget for the upcoming period. Now, after the budget has been prepared, as any business from a control standpoint, you would want to compare whether that standard cost sheet that you had prepared, wherein you had said that if, say for example, you are making this cup of coffee, and you see it, yeah, you are making this cup of coffee, how much milk would be required, how much coffee powder would be required, how much water would be required. If you're making this in a coffee machine, how many minutes does it take to make that one cup of coffee? And therefore, what is the electricity cost incurred? All of these points. You would have made a budget estimate, a standard cost card, wherein you would have included, say, 30 ml milk for 30 ml milk, considering a rate of 55 rupees per liter. You would have calculated the cost accordingly. The cost of adding 10 grams of coffee using, say, one sachet of that particular brand. Now, these calculations were made at the start of the year, that the costs will go in this particular pattern, in this particular format. Now, imagine that because of some crisis somewhere, the cost of per liter of milk has gone up from 55 to 60. So, you had calculated the cost, assuming you had created a standard cost card, you had created a budget stating that I would make one cup of coffee, and to make that one cup of coffee, the cost of 30 ml of milk would be so and so, assuming 55 rupees per liter. Now the actual cost has gone up, which means you spent more than what you had budgeted for, than what you had planned for. This difference is the variance in cost, is the difference in cost, budgeted versus actual. And this difference in budgeted versus actual is your is known as variance. Now, variance is nothing but difference. Difference in what? Difference in what you had budgeted and difference in what you actually secured. You budgeted that you would end up spending 2 hours to make one video on standard costing, but you started, there was an electricity shortage, or somebody came at the door, or whatever reason, you could not finish the job in 2 hours. You ended up taking 3 hours to finish something which basically would have taken 2 hours. So you spent more time than budgeted. That is also a variance. And the topic standard costing and variance analysis focuses solely on this. Variance analysis is the process by which the total difference between standard and actual results is analyzed. So what we are going to do is we are going to look at variance, basically difference. If you find the word variance a little overwhelming, just think about the word difference. We are going to find the difference between the all items or all components of your standard cost card. For example, we are going to look at differences between sales values, sales quantity, material spent, efficiency, all of these things we are going to evaluate. Now, when you do variance analysis, you will get a difference. This was budgeted, 100 rupees was the budgeted cost, 120 is what I actually spent. So you will get a difference between the budgeted number and the actual number, and that will be your variance. Now, variance can be either favorable or adverse. So if you did better than what you planned or expected, the variance is favorable. So in case of incomes or your sale, if the sale is more than budgeted, your variance will be favorable. Okay. And in case of so again, let's talk about incomes or sale. If the sale is less than budgeted, okay, if the sale is less than budgeted, your variance will be adverse. So if your performance is better than what you had planned, then the variance is favorable. You would want that difference to arise. So if you had planned to study for 2 hours and you ended up studying for 3 hours, it is still a difference. It is still a variance, but it is a better variance. As in, this is something you would want for yourself. On the other hand, if I'm talking about cost, okay, uh, if I'm talking about cost and I planned on spending how much? I planned on spending 500, but I was able to manage it in 400 rupees only by bargaining with the supplier or by using my resources more efficiently. Then in that case, if I spend less than what I had budgeted, the variance is favorable. So in case of costs or expenses, if you spend less than budgeted, your variance will be adverse. ठीक है? Sorry, if you spend less than budgeted, your variance will be favorable. आपने जितना प्लान किया उससे कम अगर आपका खर्चा है, you will say that your variance is a favorable variance. So your job will be to calculate the variance. We look at different formulas for doing that. Then explain how it is calculated and then comment on whether it is favorable or adverse. Now, standard costing and variance analysis as a concept is quite in depth. If you are a CA student, the CA curriculum, CA Inter, and back in the day, even CA Final, they would test the students on, they would test students in a reverse way where they would give the variances and from that, they would ask you to calculate the original values. ACCA does not test you on that level. ACCA gives you the data and expects you to calculate the variances and comment on those variances using whatever analysis and interpretation that you have made. So the next set of discussion is going to focus on variance analysis. We'll be talking about sales variance first, sales variance, followed by material variance, material cost, labor cost, overheads, जिसमें fixed and variable overheads होगा, and then we'll talk about planning and operational variances and advanced variances that you have not learned at the earlier stage.